We have huge Tesla news today. We have bullish analysts saying it's worth $750 a share. We have analysts saying it's worth $80 a share, production shutdowns, and a little bit of drama too. Hey everyone, welcome back to the channel. We have some wild Tesla stock price predictions to start, and then we'll take a look at Gordon Johnson, founder of GLJ Research, and look at what he has to say about Tesla. We'll look into the production shutdowns and what this means to you, and we'll finish it off by talking about some of Tesla's competition and which one is a better investment for 2021. This video is full of great information, so it's in your best interest to stick around to the end so that you can make smarter choices and be more successful with your investments. But before we begin the video, I just want to say a really quick thank you to those who have been liking, commenting on the videos, and subscribing to the channel. It makes putting these videos together even more fun. I love having conversations down there with everyone in the comment section, and I respond to every one of your comments. So if you want to chat about Tesla stock, or if you want to rant about your hatred for Tesla, that's fine too. Tesla has been one of the hottest stocks of 2020, with share prices skyrocketing 580% just this year, but at least one analyst says the electric vehicle company's price is too high, boasting it should be worth between $60 and $80, rather than more than $600 a share. Gordon Johnson, founder and CEO of GLJ Research, said that Tesla's lofty valuation will soon come crashing down, with a number of factors weighing on the company's stock price. Those include Tesla's upcoming addition to the S&P 500 set for December 21st, which Johnson said could see shareholders who are putting money into the stock ahead of the anticipated event pulling back, and the loss of government-backed EV credits from rival automakers. Johnson believes Tesla stock should be viewed as akin to the likes of overhyped stocks like cannabis company Tilray, which saw a massive run up to nearly $150 a share in late 2018, only to fall back to $7 a share. He also puts Tesla in the same ranks as a renewable energy company SunEdison, which filed for bankruptcy in 2016 after seeing its stock price rise higher than $32 a share, only to drop 99% in 12 months. Johnson said, "You've seen this before, I know it sounds crazy, look at Tilray, look at SunEdison, look at Suntech, look at some of these stocks. They went from $5 to $300, back to $5. They went from $2 to $300, back to $0. Johnson said, "It does happen, and we think that Tesla is a prime candidate." Tesla's stock is notoriously as polarizing as its CEO, Elon Musk. In November 2018, Musk told Axios and HBO that the company had been single-digit weeks away from death during the ramp-up in Model 3 production. Prior to that interview in August 2018, Musk had tweeted that he was taking Tesla private at $420 a share and that funding was secured, even though it wasn't. The Securities and Exchange Commission sued Musk over the tweet, and he agreed to pay $400 million in penalties. This year, Musk may have raised some eyebrows again when he decided to temporarily stop its Model S and Model X production lines from 18 days from the December 24th due to January 10th. Johnson called the decision baffling in light of recent suggestions from Musk that Tesla needed to ramp up production. Just a few days ago, Musk put out an internet email that was leaked to the public that said they were effectively production constrained. They needed to significantly increase production, so I think it's one of two things. A, being in demand is a problem, or B, they need to retool or refurbish the model to make it more attractive. But not all analysts see Tesla as such a risk. Other analysts, however, see Tesla as a continued growth story. Early this month, the company tapped the equity markets to the tune of $5 billion to fill its war chest and ensure it can build out factories and reduce debt. In a recent research note, Wedbush analyst Dan Ives said the move alone helps cut down the bear case against Tesla. Musk and his red capes are raising enough capital to get the balance sheet and the capital structure to further firm up its growing cash position and slowly get out of its debt situation, which throws a lingering bear thesis for Tesla out of the window for now. Ives wrote, "For his part, Johnson sees the bullish sentiment around Tesla as unfounded, suggesting Wall Street analysts have been purposely underestimating Tesla's deliveries so it will exceed expectations. According to Johnson, the company estimates Q4 deliveries will come in at 180,000, while other analysts are saying the company will have much lower numbers. That, Johnson says, allows Tesla to beat the broader street consensus, helping boost the stock." Outside of the S&P 500 and production issues, Johnson points out that Tesla is losing market share in China to rivals jumping into the EV space, with market share in China standing at 12.5% compared to 25% earlier this year. However, China still represents a massive growth opportunity for Tesla. According to Ives, who predicts the country could account for nearly half of its global sales by 2022, even domestic players in China are firing on all cylinders, said Dan Ives in December 13. Note, Tesla's flagship Gigafactory in Shanghai gives it a major competitive advantage, which, by the way, firing on all cylinders is probably the worst car pun someone could use when talking about electric vehicles. What would be the electric vehicle equivalent of firing on all cylinders? If you can think of one, drop it in the comments. If you want your best return for your money in 2021, which EV stock should you buy? Let me tell you why NIO stock could be the smarter choice. Two of the most popular stocks on the planet right now are electric vehicle manufacturers NIO and Tesla. Together, they trade about 200 million shares daily, thanks in large part to the young individual investors hungry for a piece of the action. Both picks have long-term potential, as they are core players in the long-term growth of the electric vehicle market. But if I had to pick just one to purchase at this price and hold for all of 2021, my money is on NIO over Tesla. Here's why. Tesla is not shorthand for EVs. An analyst at Roth Capital Partners said in November, Tesla is an umbrella stock that is tied to all other names in the sector. I don't dispute that, but I don't see it as a good thing. While it certainly has more direct link to electric vehicle adoption than a company like Ford, that is still lagging way behind the pack. It's dangerous to think that more EV sales definitively means an ever-increasing market value for Tesla. Just as a tech bubble separated the powerhouses like Google from pretenders like theglobe.com, eventually markets will stop buying the trend and start looking at individual stocks. That could be dangerous for Tesla given its sky-high valuation. Tesla has a long way to go in China. Through much fanfare has been made about the China-made Model 3 vehicles, Tesla only sold about 21,600 of the cars in November. That was good enough to be number 3 in market share, but certainly not a game changer, and less than 1/3 of the monthly run rate necessary for the forecast of the 880,000 China-made EVs by the end of next year. Where's Tesla's China explosion? Total electric vehicle sales in China are living up to expectations, with November's tally surging more than 130% to 169,000 units. While Tesla dominates the US market, its 21,600 units sold in China is a very tiny sliver in a crowded field. What's more, the raw China growth rate for Tesla may be impressive, at 45% more vehicles sold compared with the 15,000 vehicles it sold in June. But it's really hard to get excited about a measly 6,000 more vehicles produced after 6 months when the stock is valued at more than 600 billion. NIO's growth is for real, but from a smaller base. So far in 2020, NIO has admittedly only delivered 36,700 total vehicles, but that's more than 110% more than 2019's tally, and it's aggressively investing to keep production ramping higher. While Tesla's China growth has to be digested as part of an established multinational company operating in the US and Europe, NIO can capitalize on the China opportunity directly. If you recall the early days of Tesla, the EV manufacturer sold people on the promise that 30,000 deliveries could become 300,000 in just a few years. And NIO appears to be tracking that growth plan too. NIO has ties to state-owned allies. Recently, NIO signed a deal with State Grid Electric Vehicle Service Co., a part of China's massive state-owned utility. The plans are modest, to jointly build about 100 charging and EV service stations for 2021, but show that NIO is doing what all successful Chinese stocks must do, which is win favour with state-owned allies to continue growing its business and squeezing out competitors. Meanwhile, Tesla's factory is 100% American-owned, and while Chinese banks provide the $1.4 billion loan for the facility, that's far different than a business partnership with partners in Beijing. NIO doesn't have Tesla's hype machine. There's no middle ground on Tesla right now. Goldman Sachs has a price target of $780, while JP Morgan Chase is at $90. Hedge fund icon Jim Chanos put it pretty well on Bloomberg TV recently, saying Tesla is worth whatever people want to believe Elon Musk is touting. Also, it's likely that if NIO does get delisted, it won't be for quite some time. Things like this take ages to come into fruition. Remember when they tried to ban that TikTok dance app? Yeah, it never happened. I know it's a very different context, but governments are always years behind, and at the end of the day, only accomplish 1% of what they claim, so don't be too concerned about NIO for now. You can keep trading all you like for a while. That's all for today. I put a lot of time and effort into this video, so if you enjoyed this video and watched this far, you're a legend and I appreciate you. So, like the video, subscribe to the channel, thank you, and I'll see you in the next video.